Thank you for joining us this morning for our annual meeting of the New York State Financial Control Board meeting. And I just want to give a couple acknowledgements and reflections on the front end as well, but also want to acknowledge our mayor has joined us, as he's obligated to do. We're happy he came. The Mayor Mamdani is his first opportunity to do this. We look forward to his remarks. Our State Comptroller, Tom DiNapoli. Thank you for all you do, Mr. Comptroller, keeping a watchful eye on the state. Similar role for the city. Comptroller Mark Levine has joined us. Michelle McManus, our Deputy Director of Finance and Capital Analysis for the Control Board, who plays a major role here for us. We appreciate that. Marjorie Henning, a member of the Control Board. Bill Thompson, a member of the board. Blake Thompson, the Budget Director from New York State, and all the observers and staff members who are here today. We welcome you. For more than 50 years, New York State has, through the Financial Control Board, played a vital role in safeguarding the financial health of New York City. When I took office, I intended to change the way that governors worked with local leaders across the state, operate as a true partner, delivering for our shared constituencies. In the last 5 years, I'm proud to have delivered unprecedented financial support to cities and counties from Western New York to Long Island. And that's why when the mayor inherited a significant budget deficit that threatened the services that New York City relies on, I thought it was our responsibility to step up, help City Hall close the gap, get the city on stable financial footing, and preserve the city's access to capital markets. That's a win for 8.5 million New York City residents that we both represent. It's a win for all New Yorkers, given that the city's important role as an economic engine for the entire state. It has also allowed us to partner to deliver on our shared affordability agenda, advancing universal health care, child care, and helping drive down the costs for New York families. I look forward to hearing more details from Mayor Mamdani on the city's financial outlook, because a strong New York City means a stronger New York State. And that's the partnership that I'll never stop investing in. I'll now call the meeting to order. I'd like to note that Matthew Harnish is the observer for the Speaker of the Assembly. Doreen Insarah is the observer for the Senate Majority Leader, and Mark Wardzel is the observer for the City Council Minority Leader. They're all here today. I'll now entertain a motion to approve the minutes of the last annual board meeting, which was held on August 13, 2025.
So moved.
All right. Thank you. Anyone, all those in favor, signify by saying aye.
Aye.
Nay? The ayes have it. The next item on the agenda is the financial plan for fiscal years 27 to 2030. Mr. Mayor, I understand you'll present the city's four-year financial plan. Mr. Mayor?
Good morning. Thank you so much to our chair, Governor Hochul, for convening us. I also want to acknowledge, as the governor did, the controller of the state of New York, Tom DiNapoli, and the controller of the city of New York, Mark Levine. And thank you as well to FCB Deputy Director Michelle McManus and your team, as well as to our Budget Director Sharif Suleiman and his staff for their hard work over a challenging budget cycle. 51 years ago, when this board came into existence, our city was in the midst of a historic financial crisis. We had billions in debt, an enormous operating deficit, and no access to credit. Simply put, New York City was out of money. This board was created to ensure that our city would never reach a similar precipice ever again, and that recklessness would be replaced by responsibility. That same commitment to fiscal responsibility has defined our approach to budgeting since we took office in January. We inherited substantial challenges, with numerous causes including years of chronic underbudgeting, structural imbalances, and numerous inefficiencies. And yet, over the months that followed, with the partnership of so many in this room, most of all, Governor Hochul, we demonstrated the responsible fiscal management needed to address these challenges and to strengthen our budget. In May, we announced an executive budget that acknowledged years of under-budgeting for known needs and still balanced the budget. At adoption, we balanced the fiscal year 2026 budget at $125.1 billion, and we balanced the fiscal year 2027 budget at $125.8 billion. All of this was done without slashing services and while maintaining more than $7 billion in budget reserves. And we have listened to the long-standing critique of monitors, several of whom are seated here at this table. As a result of our Code Charter Commission and our partnership with Controller Levine, New Yorkers will vote for the first time on the city's reserve practices, potentially allowing the city to make meaningful reforms to how the rainy day fund is managed. This budget was a testament to government's ability to lead boldly, innovatively, and transparently. and it was a reflection of our conviction that responsible budgeting does not look like temporary fixes or stopgaps, but structural reforms and long-term efficiencies. We appointed chief savings officers at every city agency and tasked them with achieving aggressive savings targets. In just a few months, they identified $1.77 billion in savings initiatives over just 2 fiscal years. And we pursued enduring stability by enacting systemic solutions to systemic challenges. We invested in special education services, delivering our students the resources they deserve, while taking on the skyrocketing cost of due process cases. We worked to stabilize city FEPS, providing voucher holders with support, while also working to protect the program's fiscal sustainability. We added $1.5 billion, for a total of $7.6 billion, to the SCA's 5-year capital plan, so that we can properly implement the state law capping class sizes on a realistic timeline. By taking steps to address rapidly growing costs in these programs, we identified $1.2 billion in cost containment savings this fiscal year, and more in out years. And our work did not stop once the budget passed. Just 2 weeks ago, we directed city agencies to identify 2.5% savings for fiscal years 2027 and 2028, as well as the remaining out years, setting ambitious savings targets early. This budget made investments in a better, more affordable New York City, including our partnership with the governor to deliver universal childcare, the creation of a new Office of Community Safety, investments in street safety and trash containerization, and the baselining of funding for core services like our parks, libraries, cultural institutions, and transit programs. So much of this progress came as a direct result of New York City and New York State working closely together on behalf of the New Yorkers we are proud to both represent. Budget negotiations have long been characterized by attacks and blame. Together with Governor Hochul, Majority Leader Stuart Cousins, and Speaker Carl Heastie, we have charted a different course. I am grateful for their financial support for the city, whether through direct aid, savings measures, or new revenues, and deeply encouraged by this new era of collaboration we are committed to ushering in. This includes hundreds of millions of dollars in direct aid, billions of dollars in state authorization, and $500 million in new revenue, including a historic pied-à-terre tax on second homes worth more than $5 million. And we also appreciate that our partners in Albany have worked with us to restore cost shift placed upon the city in recent years, including line-of-duty death reimbursement, youth programming, Article 6 public health, and sales tax intercepts. As a result, only 8 months later, our city is on far more stable financial footing. We have maintained strong reserve levels, higher even than the pre-COVID 10-year average. We made a nearly $2 billion prepayment from fiscal year 2026 into fiscal year 2027. This is up from $74 million in November 2025 and nearly double the level it was in the executive budget. And our pension system is funded at 86%, 7% higher than the national average of 79%. I am proud that together we are building a local economy that is resilient despite national and international headwinds. We are at an all-time high for total jobs in our city at more than 4.85 million. Private sector job growth is at 1.3% year over year, nearly 3 times the national job growth of 0.5%. Our city's unemployment rate fell to 5.3% in June, the 4th consecutive monthly decline. Our labor force participation rate is at 62.5%, the first time in roughly 50 years that New York City's labor participation rate is higher than that of the nation's. New York City's post-pandemic recovery continues apace, with bus ridership increasing and subway ridership up nearly 5% year over year. And New Yorkers are riding those buses and subways back to the office. The vacancy rate declined to 19.3% in the second quarter of 2026, the 13th consecutive month of decline. And office leasing is on pace to match 2025, the strongest year since before the pandemic. Crime is down, with record lows in murders, shootings, and shooting victims, both ensuring that New York City is safer and making our city more appealing to businesses and to talent. The Knicks championship and the World Cup also boosted spending and tourism in our city, with hotel room rates up 15% in June 2026 over June 2025. And I'm proud that despite the challenges we faced at the beginning of the year, the credit rating agencies continue to hold confidence in our city's long-term financial outlook, with our strong ratings maintained. Recently, Kroll also revised our outlook upward to stable, another sign of our city's fiscal resilience. As we look forward towards the future, there is real cause for optimism. NYSC member firms recorded profits of more than $20 billion in the first quarter of 2026 alone, nearly half of the anticipated projections of full-year profits. Wall Street continued to record tremendous profits in Q2 of 2026. Companies are leasing offices with hundreds of thousands of square feet, and in the case of American Express, building a new global headquarters in Lower Manhattan. I know that optimism is reflected in the projected tax revenues prepared by both Controllers Levine and DiNapoli, as well as this board. While we maintain our cautious approach, I appreciate the positivity you hold in anticipating that tax revenue will be even stronger than forecasted in the financial plan. 51 years ago, this board was established as a careful steward of New York City's finances. For 51 years, you have helped this city emerge from darkness and then maintain its path towards stability and prosperity. It is an honor to lead this work alongside you, alongside Governor Hochul, and alongside the millions of New Yorkers for whom this financial stability is no abstract concept, but the foundation of a better, more dignified, more affordable life in the city we all love. Thank you, and with that, I will pass it over back to Governor Hochul.
Thank you, Mayor. Controller DiNapoli, do you have any comments on the city's financial plan?
I do, Governor. Thank you very much. Thank you once again, Governor, for convening us. And Mayor, thank you for your maiden voyage here and with a great report. Really well done, well done. I certainly want to acknowledge my colleague in the controller world, Mark Levine. Great to see you as well for your first control board meeting in this capacity. And our public board members, Bill Thompson, who taught me so much for my responsibility. So any lapses in my ability to deliver is your fault as my mentor. And certainly to Marjorie Henning as well, our public board members. Certainly want to also thank Michelle McManus and the Financial Control Board staff. Very professional relationship, and we really appreciate working with you. Today we released our report on the city's fiscal year 2027 budget and financial plan. We've distributed copies for the board. I want to acknowledge our Deputy Controller for New York City in the State Controller's Office, Rahul Jain. Rahul and his team are the ones who did the great work on this report. A year makes a lot of difference. A year ago, I was here explaining that the city had developed a habit of under-budgeting major expenses, often by the billions. Then, as the fiscal year went on, the city found billions in resources, often from revenues beating its very conservative estimates and drawing down on its surplus roll. This past lack of transparency created a shock for some when the new administration took the step to more fully disclose these costs and provide more realistic revenue projections to help pay for them. Put this into perspective. My office projected $127.7 billion in spending entering fiscal year 2027, while the prior city administration pegged these costs at just under $122 billion. The city's adopted budget now projects spending at over $127 billion in fiscal year 2027 as well, inclusive of prepayments. This budget transparency is so critical for enabling a more honest discussion of the city's fiscal challenges. After some initial confusion, this has helped the public understand more about what is really happening with the city's finances. These conversations have not always been easy, but I really want to commend the mayor for taking a much more realistic, open, and honest approach to budgeting. With that goal of transparent and open dialogue in mind, let me provide some observations from the State Controller's Office on the city's current economic and fiscal outlook. The story of fiscal year 2026 was dealing head-on with under-budgeted expenses, which had created a distorted perspective of the costs that were fueling growth of the city's budget gaps. Revised expenditure projections included public assistance, rental assistance, subsidies to the MTA, and overtime, along with a host of smaller under-budgeted items for health care and mental health, youth programs, and legal services. The amount added to address the under-budgeting issue was not small. In fiscal year 2027 alone, these costs amounted to more than $6.4 billion in under-budgeted expenses that were not included at this time last year. These were not the only new expenses added, however. The city has had to deal with higher than anticipated health care costs, judgments, and claims. It has also funded several new initiatives, including 2K, which is expected to expand and require more resources in the coming years. Overall, more than $10 billion in new agency needs was added to fiscal year 2027 since we spoke a year ago, a substantial addition to spending for any year. The recognition of these expenses required several budgetary decisions to close the gap. On the spending side, the city substantially expanded its FY 2026 citywide savings plan in February. In May, it added cost containment strategies for major cost drivers, a prudent first step that was enabled only after the city accurately accounted for these items. Despite these efforts generating $3 billion in resources this year, it was once again the city's revenue growth that was the biggest factor that allowed the city to maintain balance in fiscal year 2026 and achieve budget balance entering fiscal year 2027. City fund revenue exceeded adopted projections by $5 billion in fiscal year 2026, the sixth year in a row that exceeded expectations at budget adoption by at least $3.5 billion. In what has become a common refrain, I'd say a welcome refrain, Wall Street had a very strong year, with profitability supporting business tax growth exceeding 7% and a record-sized bonus pool helping preliminary PIT revenues exceed 12% growth over the prior year. While Wall Street has been a key part of the city's economic growth story in recent years, I do want to caution that the sector is prone to cycles. The share of local wages attributed to the industry, which drive personal income tax collections, is rising again, leaving the city, as well as the state, prone to revenue volatility associated with the financial sector. Concerns over the city's largest revenue source, the property tax, have also abated as commercial real estate has strengthened. Asking rents and vacancies in the city's office market continue to outpace other large office markets across the nation, and the retail sector has also experienced improvement. Residential property values, which have been more resilient since the pandemic than commercial values, saw another year of strong growth in the fiscal year 2027 property tax roll. Tourism numbers also came very close to full recovery, but choices made at the federal level on trade and immigration stalled years of improvement in 2025. Sales and hotel taxes continue to strengthen, however, and the city remains a leader among national destinations in the recovery of visitors. All of this is to note that the pressure to balance the budget comes not amid revenue weakness, but a period of economic and revenue strength. Concerningly, despite slow but steady economic growth, better than projected revenues were not enough to close the gap once expenses were properly budgeted. The city also anticipated revenues that required approval of the state, including a new second home surcharge along with decoupled business taxes from provisions in the federal H.R. 1 bill to close the budget gap. Even with these new resources, additional state aid, and several one-time actions on spending, including a significant pension restructuring, were needed to achieve balance. Current revenue projections anticipate that growth will continue. While this is not unreasonable, a recession and/or actions taken in Washington remains the most concerning risks facing the city's finances. Fiscal risks stoked by federal actions have hung over us for the last 2 years. Tariffs, immigration, energy inflation, politicizing the disbursement of federal funds. It can feel like planning and preparation is an exercise in futility due to the shifting landscape. But I would suggest this is exactly the time to plan, prepare, and develop options that will provide us with choices down the road and alleviate more difficult decisions later. Even if federal and economic risks can be avoided, the city faces its own questions about growth and certain difficult-to-control costs, such as health care, the cost of new and expanded programs, including child care, and the negotiation of the next round of labor contracts. These questions, too, will be easier to solve if steps to prepare are accelerated now. The July announcement of a 2.5% savings target for fiscal year 2027 shows that the mayor and the city understands this, but more can be done. Since state fiscal year 2022, the state has been consistently growing its fiscal cushion, compliments to the governor and to the legislature. The state has about $15 billion across its 3 rainy day reserve funds, about 11% of state operating fund spending in state fiscal year 2027. The city, by contrast, has about $2.5 billion entering the fiscal year, including in-year reserves, or nearly 3% of city-funded spending. Inclusive of the Retiree Health Benefits Trust, which provides additional budgetary flexibility, the city's available resources would be about 8% of fiscal year 2027 city-funded spending, still below the state's reserve percentages. As I've recommended, the state has consistently shifted from reliance on informal reserves to making consistent deposits to its statutory rainy day reserve funds, which now have the highest balance in the state's history. The state has made deposits in each of the last 3 years, in contrast to none made by the city over the same period. The Charter Revision Commission's proposed amendment, as the mayor referred to set guidelines for the city's reserves is only the first step in putting together a robust reserve policy with purpose and structure. I urge the city to develop a policy that responds to what fiscal monitors have already suggested. This will allow the city to make decisions out of a position of greater fiscal strength over time. Occasionally at past Fiscal Control Board meetings, I brought up the fiscal discipline embedded in the Financial Emergency Act that provides a blueprint for managing city finances in a prudent manner, while also giving confidence to investors who buy the city's bonds. These measures, which include borrowing deficit financing without state approval, gap-based budgeting, the timely presentation of regular budget updates, and adoption of a balanced budget, contingencies in the expense budget, and the continued meeting of this board, all continue to provide confidence that the city is working within ample controls and under state oversight, and that fiscal issues will be discussed in a transparent manner. But changes to modernize the city's fiscal controls beyond the Financial Emergency Act, like the ability to enhance its rainy day fund, for example, should be done with the same discipline. As a case in point, the now amended planned use of reserves to achieve budget balance proposed in February, despite a growing economy, was cited by rating agencies as part of the justification for the city's outlook revision. More than 50 years of operating within these rules, even with slight adjustments, has rightfully given confidence to those who monitor the city's budget. But it does not take long for that confidence to be questioned, especially if actions taken go against the spirit of the rules. At the start of my remarks, I commended the mayor and the city for transparently reflecting spending that for years was known to be out of step with reality. Now, as I close my remarks, I would like to note that this type of transparency can and should be expanded. First, restarting quarterly meetings on the progress of the city's savings programs with the city's fiscal monitors. This stopped during COVID, but did not restart and coincided with an era of unrealistic spending projections. This would provide the public with information and the city with an extra set of eyes on its success in achieving planned savings. Second, laying out the full costs of significant initiatives that it plans to undertake, such as expanding child care supports, would provide a more comprehensive understanding of what the budget risks could be and the funding needed to close future gaps. This is critical as we enter a period where it is likely that additional revenue options will be discussed. Lastly, tying program funding to outcomes, which is still too difficult using the city's current financial reporting and performance indicators, would go a long way to start to show the public how money is being used. So, to wrap up, the city owes it to its residents and businesses to communicate the budgetary and operational challenges before us and be transparent about how the city intends to overcome them without hurting affordability or adding to burdens that could weigh down future economic growth. As always, the Office of the State Controller stands ready to assist in any way we can, and we will continue to monitor the revenue and expense choices being made to analyze their effects on the city's services and quality of life. Again, my compliments to the mayor and the city controller, and my thanks to all of my colleagues on the board, and certainly the staff as well of the control board, the staff of the mayor's office, the city controller's office, the city council, the State Division of Budget, for all of your work, and we do appreciate the collaboration of all the entities represented on this board. Thank you, Governor.
Thank you, Comptroller DiNapoli. Comptroller Levine, you have any comments on the city's financial plan?
Yes, I do. Thank you, Governor Hochul. Thank you, Mayor Mamdani. Thank you to fellow member of the Comptroller Caucus, Comptroller DiNapoli, and my esteemed predecessor, former Comptroller Bill Thompson. Thank you to our public board member, Marjorie Henning, and thank you, Michelle and the team. Very grateful for this chance to share my office's assessment of New York City's fiscal year 2027 adopted budget. I want to begin, like the State Comptroller did, in thanking Mayor Mamdani and his administration for taking important steps to provide a more honest and accurate picture than the prior administration had of the city's finances, in particular by largely ending the practice of under-budgeting known costs and by adopting revenue forecasts that are, on the whole, reasonable. These actions have helped establish a more credible foundation for the city's financial plan and for the budget decisions that lie ahead. I also want to thank Governor Hochul for providing additional state aid and flexibility that helped the city address important fiscal challenges that we inherited this year. I'm grateful to Comptroller DiNapoli for his continued partnership and his responsible stewardship of the state's finances. And I also want to thank the private members of the Financial Control Board for their service and ongoing engagement. The city's fiscal health depends on continued partnership with the state and with its fiscal oversight institutions. That partnership is especially important as we work to preserve the city's economic strength while addressing long-term challenges that remain in the fiscal plan. New York City's tax base remains strong and is in fact at record levels. I know there's been some attention paid to a recent increase in the city's bond yields, so let me address that directly. That movement does not reflect an eroding tax base or an expectation of a ratings downgrade. The yields simply followed broader market dynamics, and the city's credit remains strong. The strength of our city's economy, and the financial industry in particular, has provided a major boost to our budget. From business income to bonuses to capital gains, the city's coffers are the beneficiaries of the bull market, and specifically the AI investment boom. Indeed, this year's revenues exceeded what the mayor himself had characterized back in February as an aggressive projection. This momentum makes, in my office's and most fiscal monitors' views, the administration's forecast for FY27 and beyond a reasonably cautious foundation for the upcoming budget cycle. But as the state comptroller said, we should not take the current economic strength for granted. The city must support and cultivate the conditions that allow us to achieve greater competitiveness and robust expansion. We must recognize that economic conditions can change rapidly. Periods of strength, such as that which we enjoy now, should be used to improve the city's long-term fiscal position and prepare for uncertainty ahead. The unpredictable federal policy environment, a geopolitical climate that moves oil prices daily, and the still unresolved question of the extent to which the AI investment boom will disrupt labor markets or are running on inflated expectations, all are downside risks to the city's projections. The administration has achieved some progress in addressing the structural imbalance between revenues and expenditures, but that work is not yet done. The fiscal plan leans heavily on short-term and one-time measures, $6.1 billion between the reamortization of the pension liability, state aid, and extraordinary accounting adjustments. Those measures closed gaps in the near term, but did not resolve the underlying imbalance between what the city spends and what it takes in every year. This imbalance is evident not only in the financial plan, but also in the necessity of increasingly active management of the city's cash position. Just last June, the city used the Retiree Health Benefits Trust to delay the annual payment of retiree health benefits in order to disperse contractual advances to nonprofit vendors. This should not become a recurring practice. Instead, we must improve our structural imbalance, pay vendors on time rather than relying on large advances, and avoid shifting the timing of other outlays to manage cash flow. While these challenges remain, the city's fiscal outlook has benefited from some important and good news. The returns on the portfolios constructed by our office's investment professionals for the pension systems have once again exceeded their target and will therefore lower the city's pension costs. In FY 2026, the combined return across the 5 pension funds was 13.0%, well above the 7.0% actuarial assumption. This will lower the city's pension contributions by $6.3 billion for FY28 and between FY28 and FY32, and will provide $600 million in additional budgetary savings beyond what has already been incorporated into the financial plan. Inclusive of these pension gains, the out-year gaps are not as large as we projected in early June, but they remain significant, $7.25 billion in FY28, narrowing to $6.84 billion by FY 2030. It's true that should the economy continue to expand at the current pace, tax revenues could exceed projections, but the potential upside must be balanced against significant spending risks. The financial plan does not account for the potential costs of future labor contracts or the possibility that spending on city FEPs, overtime, or due process cases will prove hard to control and contain. These risks increase the importance of achieving recurring savings and engaging in long-term fiscal planning. And I was heartened by the mayor's newly announced savings target for city agencies, 2.5% of city tax levy funding annually through fiscal year 2030, which is an important step in the right direction. Announcing it early gave agencies real time to find genuine efficiencies rather than simply one-time cuts dressed up as savings. By our preliminary estimate, a target of this size would save the city up to $1.5 billion a year, depending on how many exemptions are applied. To build on its progress in improving budget transparency, the administration should commit to clear, regular public reporting on these and its previously announced saving plans. My office would welcome the opportunity to partner with the administration and other fiscal monitors, as we did in past years, to assess implementation progress. Regular and transparent reviews will help identify what is working, where additional action is needed, and whether planned savings are being achieved. A strong economy is not a time to relax. It's not a time to let our fiscal guard down. It's a time to prepare for the moment when conditions turn. And they eventually always do. Well-funded reserves are what stands between an economic downturn and cuts to the essential services New Yorkers depend on. That's why my office has spent this past year pushing for clear, formal rules governing how reserves are built and when they may be used. Unfortunately, no deposit was made in the rainy day fund in fiscal year 2026. This in a year of record tax revenues. Using the formula my office put forward, the deposit for 2026 would have ranged between $1.4 billion and $1.7 billion, depending on where tax revenues ultimately settle. I welcome the Charter Revision Commission's attention to this issue, and the proposal it has advanced represents substantial progress. I must say that the Commission's proposal is weaker than what I and some advocates had pushed for. The construct gives leeway to commingle rainy day funds with other reserves, and the framework for the deposit formula could make it too easy to circumvent. There's also no improvement in the withdrawal rules already in effect in state law. Nonetheless, I believe the proposed charter amendment represents an important step in the right direction, and should it be enacted, I look forward to exercising my office's influence and consultative role in the derivation of the fund's governing methodology. Getting this right is one of the most consequential things we can do to ensure that vital city services can continue in an economic downturn when New Yorkers need them most. I'll end with this. New York City enters this budget year from a position of real economic strength. This administration deserves credit for meaningful progress towards a more transparent and responsible budget. But significant work remains to reduce reliance on temporary measures, to convert savings targets into real savings, to build adequate reserves, and to prepare for economic uncertainty ahead. If we do that work now, we can protect both the city's fiscal health and the essential services New Yorkers rely on through whatever challenges come next. My office looks forward to continuing to work constructively with the mayor, the governor, the city and state legislatures, the state comptroller, and this board to build a fiscally sustainable future for New York City. Thank you.
Thank you, Comptroller Levine. Now I'll turn it over to Michelle McManus, the Deputy Director of Finance and Capital, to present the staff's comments.
Thank you, Governor. The following is a summary of the main points made in the Control Board's report released last week. The city's economy continued to expand during the first half of 2026, although growth is uneven across sectors. Labor market conditions softened modestly, tourism weakened further, and inflation remained elevated. At the same time, wage growth strengthened, commercial real estate continued to stabilize, and subway ridership maintained its gradual recovery, underscoring the city's continuing resilience despite a more uncertain economic environment. In the June financial plan, the fiscal year 26 budget at $125.1 billion was increased by $9.2 billion since the start of the fiscal year, with the non-city fund portion increasing by $4.2 billion and the city fund portion by $5 billion, largely reflecting a $4.3 billion upward revision to tax revenue projections. On the spending side, city-funded expenditures increased by a smaller $3 billion from the June 25 adopted budget. Agency spending increased by almost $9 billion, but much of this upward revision has been offset by lower expenditures elsewhere in the budget, including $1.4 billion from the savings program, a $1.7 billion write-down of prior year accruals, and the removal of budgeted reserves, which included $1.2 billion general reserve and $250 million from the capital stabilization reserve. The state enacted budget also provided significant expenditure relief in fiscal year 26, including $360 million primarily for Raise the Age assistance, as well as $753 million of the reduction in pension contributions, largely reflecting the extension of the amortization period for unfunded accrual liabilities and the restoration of cost sharing for the line of duty death benefits. The change in city fund revenues and expenditures created a fiscal year 26 budget surplus of $1.96 billion, which was used to prepay fiscal year 27 debt service, resulting in a balanced budget under generally accepted accounting principles, GAAP. Despite ending the year in balance under GAAP, fiscal year 26 continues the city's recent pattern of relying on prepayments to achieve budget balance. Fiscal year 26 benefited from a $3.8 billion prepayment, effectively carrying forward accumulated budget surpluses from prior years. Although fiscal year 26 is balanced on a GAAP basis, it reflects an underlying operating deficit of $1.8 billion. This marks the fourth consecutive year of an operating deficit and the largest since fiscal year 20. The fiscal year 27 adopted budget totals $125.8 billion, an increase of $1.1 billion from the executive budget. The revision reflects a $336 million rise in the non-city fund portion of the budget and an $807 million increase in the city fund portion, while expenditures were increased by $1.7 billion, resulting in an $896 million budget deficit. However, revisions to the fiscal 26 budget generated additional surplus, which was added to prepaid debt service, offsetting the shortfall. The increase in fiscal year 27 city fund revenues is driven by a $300 million increase in tax revenue forecast and $490 million in unrestricted state aid. The increase in unrestricted state aid reflects a shift in the timing of revenue recognitions rather than additional state support. The city-funded expenditure increase of $1.7 billion primarily reflects $1.5 billion in higher agency expenses, $706 million in city council initiatives, and a $350 million increase in the general reserve. These increases were partially offset by $397 million in additional savings program initiatives, a $207 million reduction in debt service, and a $260 million reduction in the labor reserve. Despite the increase, the general reserve totals only $450 million, well below the $1.2 million level at the beginning of recent fiscal years. In addition, the reduction in the labor reserve lowers the cushion available to offset the costs of the next round of collective bargaining agreements. The financial plan also continues to assume savings not yet tied to specific initiatives in fiscal years 28 to 30. The mayor's July 28th directive requiring city agencies to identify 2.5% in savings for fiscal years 27 and 28, as well as the out year, could replace these unspecified savings with specific agency initiatives while also mitigating the risk of an over-reliance on a few large recurring cost containment initiatives. Beyond fiscal year 27, the June financial plan projects budget gaps of $6.4 billion in fiscal year 28, $8.2 billion in fiscal year 29, and $8.5 billion in fiscal year 30. Over this period, city-funded expenditures are projected to grow at more than 2.5 times the rate of city fund revenues. The Financial Control Board estimates that the city could face a potential gap of $441 million in fiscal year '27 and a larger gap of $6.7 billion in fiscal year '28, as our risk to the plan expenditure estimates offset our higher revenue forecast. However, in the out years, offsets from our higher revenue forecast exceed our expenditure risk, resulting in smaller gaps of approximately $7.8 billion in fiscal years '29 and '30. Okay, the city has outlined a 5-year capital plan for fiscal years '26 to '30, amounting to $117 billion in total funded authorized commitments released with the executive budget. The city is placing a high priority on building and upgrading of schools, increasing the affordability of housing, as well as the construction of new borough-based jails. The resulting debt service costs will represent a rising percentage of tax revenues from 9.7% in fiscal year '26 to 13.2% in fiscal year '30. Although the city's capital program is sizable, the annual debt service is projected to remain under 15% of tax revenues, the level the city deems affordable. However, some large capital projects may be more costly than initially assumed, and debt service expenses could be higher than projected, placing added pressure on the city's operating budget. In March, 3 of the credit rating agencies, Moody's, Kroll, and Fitch, revised the city's rating outlooks from stable to negative, while S&P maintained its outlook as stable. In July, each agency affirmed its rating on the city's general obligation bonds, and Kroll revised its outlook from negative to stable. In May, Moody's also revised its rating outlook on the Transitional Finance Authority's subordinate future tax-secured bonds from stable to negative. Moody's stated that the negative outlook reflects the city's structural imbalance and reduced financial flexibility. Any downgrade to the city's credit ratings could adversely affect the city's financing costs. Thank you.
Thank you very much. I'd like to now ask if any private members have any comments.
Thank you. First, I'd like to thank the governor for her leadership and for my appointment to this board. I am truly honored to be in the company of the esteemed Bill Thompson as a private member of the FCB. Thanks also to the mayor, the city and state comptrollers, and the staff of the FCB for their comprehensive presentations. In 2024, when I was first appointed to this board, I noted the year-over-year reduction in the surplus roll, and I echo the concerns expressed today over the ever-diminishing amounts of surplus that have been transferred from one fiscal year to the next, even though year-over-year revenue growth has generally been strong. As the rating agencies and the comptrollers note, this year's surplus roll is the lowest in a decade. And the significant reductions in the surplus roll every year since fiscal year 2022 indicate an ongoing and growing structural budget imbalance. I'm also concerned by the use of largely non-recurring savings to close the projected fiscal year '27 budget gap, which contributes to future structural imbalance. For fiscal years 2028 through 2030, expenditures are expected to grow at over twice the rate of revenues. This is simply not sustainable, and I hope the city's agencies are able to identify and implement measures to achieve the 2.5%, at least 2.5% of recurring savings that will help address this growing structural imbalance. In addition, the reductions in the general reserve and the labor reserve and the elimination of the capital reserve to balance the fiscal year 2027 budget will limit the city's flexibility in responding to an economic slowdown or reductions in federal funding that are not absorbed by the state without reducing services. Given the unprecedented risks to the economy posed by the Trump administration's policies, including tariffs, immigration restrictions, and the Iran war, the maintenance of robust reserves in 2027 and in the out years is more important than ever. Given these and other challenges, I am grateful for the city's strong partnership with the state and for the budgetary framework and robust planning processes established by the Financial Emergency Act and the city's longstanding policies and procedures, which should enable the city to identify and address any future budget gaps that may arise in the future. Thank you.
Thank you, Marjorie Henning, for your service to the board, and also any comments from Bill Thompson, who knows a little bit about this. Thank you for your service.
Thank you, Governor, and let me start out by thanking you for your strong leadership. Again, you're here, and I think that sends a great message about the importance of this body, but about how much you care about the city of New York and your continued leadership and strength in making sure that the city is in a great position. Mayor Mondani, it is a pleasure to see you in your first meeting, and also to have watched the work that you've done in providing transparency and openness to budget, something that has not existed in years, but it's clear it's a new day. And also the picture of the both of you continuing to work together is reassuring to the people of the city of New York and to the state. So let me thank you both. To my, and I'm not going to say old friend, State Controller Tom DiNapoli, I'm going to say friend of long standing. To my brother, it is always a pleasure to see you. To the new face in the Controller's office, Controller Levine, you have hit the ground running and fully expect great things of you in the future. You have shown that, strong focus and the backbone that a controller needs. So again, it is a pleasure to see you. And one other person that I would have to mention, if only because the city's gain has been CUNY's loss, the budget director, Sharif Suleiman. It is always a pleasure in seeing you. I'm not sure the last time I was here, I believe that one of the public members is now the first deputy mayor. I don't know if you're going to be going someplace, Marge, but in the future. But let me also just again talk briefly about the fiscal stability and the openness that the mayor has brought and the transparency. I think we are all thrilled to have, as the budget year began, to watch you instruct agencies to find savings. The 2.5% at the beginning of the year, as opposed to waiting down the road, is something that gives us all comfort and is a fiscal stability that we haven't seen in the city in a while. So again, I look for, as I said, this body meets once a year. Given our leadership on the state level and on the city level, I expect us to continue meeting just once a year. So again, it is a pleasure to be here. Thank you.
Thank you. Any other comments? Mayor, would you like to comment on the comments?
I appreciate them.
Now we'll go into the next part of the agenda, which is the review of the fiscal year 2026 and annual determination for the FCB to remain in sunset. I'll now call on Michelle McManus to report on the staff's finding regarding FY 2026 and for the recommendation concerning the proposed resolution.
Thank you. The Financial Emergency Act contains 5 conditions that we review to determine whether or not the city is experiencing fiscal stress. I'd like to go over them now for the board. 1, the city shall have incurred a deficit in excess of $100 million in the results of operations. The city has ended fiscal year 26, subject to the final audit, with a budget surplus of $1.96 billion and has prepaid fiscal year 27 expenses. 2, the city shall fail to pay principal or interest on any of its notes or bonds when due or payable. 3, the city shall have issued notes in violation of restrictions on short-term borrowing set forth in Section 9B of the Act. 4, the controllers shall have jointly certified that they could not, on the basis of facts existing at the time of such certification, make the joint certification required to terminate a control period. The city has paid all principal and interest on its notes and bonds and has not violated any of the short-term borrowing provisions of the FVA. The Control Board has also received letters from the state and city controllers informing us that they do not see any likelihood that they would have reason to issue a joint certification relating to market access. 5, the city shall have violated any provision of the Act, and such violation substantially impairs the ability of the city to pay principal or interest on its notes or bonds when due or payable, or the city's ability to adopt or adhere to a balanced operating budget. The city has not violated any provisions of the Act. The staff therefore recommends that the board approve a resolution determining that of August 12, 2026, none of the events which would have required the imposition of a control period has occurred, nor is there a substantial likelihood and imminence of such occurrence, and that the city is not experiencing fiscal stress at this time that would jeopardize the orderly functioning of the city's fiscal affairs. Thank you.
Thank you. Any comments from Comptroller DiNapoli or Comptroller Levine or any of our members on the resolution?
I think it's a good resolution. I would move it.
I guess I have my second already. All those in favor signify by saying aye.
Aye.
The ayes have it. Before I adjourn the meeting, I do want to also give a special out to my budget director, Blake Washington, who did double duty early on. We knew that we needed to be very helpful to the city in the early days, months, and I appreciate him and his team for helping find the leadership and the collaboration that was necessary. So thank you, Blake. At this point, I'll entertain a motion to adjourn the meeting. Do I hear one? Moved by Marjorie, a second.
Second.
Second by Comptroller DiNapoli. All those in favor signify by saying aye. Aye. The ayes have it. Thank you. Meeting is adjourned.